Deere Company, ticker DE, just beat consensus across the board for their Q3 2026 earnings.
Yeah, EPS came in at $5.10, completely crushing the $4.71 consensus.
Right, and revenue hit $12.61 billion.
Which is a massive $1.79 billion beat over estimate, so that puts them up roughly 6% year over year.
Plus, management actually raised and narrowed their full-year 2026 net income guidance to between $4.75 billion and $5 billion.
And the market absolutely loved it.
Well, they definitely did.
Yeah.
The stock surged over 9% post-report, trading around $634. It's easily outperforming the broader S&P 500 right now.
Definitely a wild reaction.
Yeah, so our mission in this deep dive is to figure out exactly how a tracker company spiked its stock by 9% when, its core agricultural market is actually flashing some major warning signs.
Right. Looking at the industry data and the earnings reports we pulled, it's a really bizarre setup.
It really is. I mean, think of Deere's business right now, like a baseball team.
Okay, I'm with you.
The star player, which is precision ag, is in a massive slump. But the relief pitcher, the construction and forestry segment, just threw a perfect game to save the quarter.
That is exactly what happened here. The construction and forestry segment, or CNF, engineered a massive beat. Sales jumped 18% to $3.618 billion. And operating profits skyrocketed 84% to $436 million.
Wait, 84%?
Yeah, 84%. But the real story is the margin expansion. Operating margins jumped from just 7.7% a year ago to 12.1%.
That is wild. And they didn't get that 12.1% margin just by selling more bulldozers.
Right, not at all.
This looks like pure pricing power. They passed those inflation costs directly onto infrastructure contractors.
Right, because those buyers are currently flush with government spending cash.
Exactly.
They have captive buyers who can afford to absorb those price hikes, and that totally offset the slumping star player in your analogy.
Yeah, let's look at that drag on the business. Production and precision ag.
It took a real hit.
It did. Sales dropped 6% and operating profit took a 9% hit.
Although small ag and turf actually held the line pretty well, profit was up 28% there.
Oh, good point. But for the big precision ag equipment, I'm assuming farmers are just dealing with higher interest rates and softer crop prices.
That's the main macro pressure, yeah. But hidden in the earnings notes, there's also this dual threat of lower shipment volumes and higher production costs.
Got it. So they're getting squeezed on both ends.
They did get a slight cushion from recent tariff reductions, though, which provided a 60 basis point margin benefit.
Let's translate that for a second.
Yeah.
That basically shaved 60 basis points off their costs.
Right.
So for every $100 it costs to build a tractor, Deere just pocketed an extra 60 cents without lifting a finger.
Exactly. Helpful, sure, but it's clearly not enough to offset farmers closing their checkbooks.
Which makes this next part from the earnings call so strange to me. Because precision ag is struggling so heavily, you'd expect management to be cautious.
Oh, you mean the cycle bottom comments?
Yes. CEO John C. May is boldly claiming that 2026 marks the bottom of the current ag equipment cycle.
It's a massive claim to make right now.
And I have to push back on that optimism, especially looking at the JP Morgan notes you provided, where they just cut their price target on Deere over order concerns.
Right.
Plus, the July industry data we have shows North American tractor sales down 10.6%.
And combined sales plunged 65%.
A staggering 65%. It looks like a falling knife. How can management confidently call a bottom when the data looks like a horror show?
Well, the skepticism is absolutely warranted, but management does have a specific defense for this bull case.
Okay, let's hear it.
They point out that early order program trends, so basically farmers putting down deposits for next year's equipment, are actually stabilizing.
Interesting.
Furthermore, the used equipment inventories that had been, bottling up the market are finally clearing out.
Aye.
And perhaps most importantly, the farmers who are buying are rapidly adopting advanced technologies to increase their crop yields.
So Deere is making more money on the tech add-ons, even if they sell fewer physical tractors.
Spot on. If we connect this to the bigger picture, raising their net income guidance implies they see a definitive floor.
Even with softer markets in places like Brazil and Europe.
Right. They acknowledge those softer macroeconomic conditions, but they're basically telling the street that the worst is already priced in.
Which brings us to the ultimate question for you to ponder.
Yeah.
With Deere's stock already up nearly 30% year-to-date, is the market prematurely pricing in a 2027 recovery?
Before this 2026 trough has actually been fully tested.
Exactly. Something to keep an eye on.
That is the multi-billion-dollar question. Thanks for joining us, and make sure to follow the show for your daily earnings coverage.